Greetings and welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our derivatives advisor, partner in crime, contributor for LaDuc Trading clients, Hans Albrecht. And he is coming from Toronto, I'm from Boston, and we're basically coming together to talk market, sector, stocks, how to play it with options. And at the top of the kind of questions that we got yesterday when we did our live member huddle for members was what's going on with VIX, and specifically how to use this elevated IV, this VIX structure that we have right now, curiously, into lots of different positioning in trades. And then mostly, I want to know, Hans, your opinion of, do you think volatility right now is mispriced because of all of the drama that's unfolding into the election, into the Middle East conflict, hurricanes, oh my. Do you think it's actually mispriced? And what do we do with this instrument?
Well, good to be here again, Samantha. I think there are a couple ways to look at it. Is it mispriced from the perspective are there things to worry about? Absolutely. We have lots of things to worry about. And I think important things as well. So there's no question that volatility markets are looking to something potentially being an issue going forward. The VIX, of course, looks 30 days ahead. And as we know, we've got this big thing called the election coming up. And the VIX sort of picks a band of days to look at. So from 23 days to I think it's about 37 days. So it doesn't just look at 30 days forward. It looks at this kind of wide band. So it still is incorporating that election event a little bit before and most certainly a number of days afterwards. So we have the VIX really kind of worried about that specifically. And then, of course, we have these other things, the geopolitical issues, and the dock worker issue came and went for now. And certainly, I think markets are a little bit worried about this CPI number. I think it's kind of a big number. As you know, I'm of the opinion that maybe we do get a little bit of a bump up in pricing pressures at some point, given the strong economy, and maybe that fades at some point. But there are things to worry about. But number two, is the market actually worried? Well, look at the stock market. I mean, we closed almost on the highs today. So from that perspective, we have a kind of a tale of two sorts of markets here. One in which stocks are very, very bullish on things going forward. They keep hitting all-time highs. I mean, there of course are pockets of strength and weakness, and we know and there's a little bit of hopscotch being played out there. But stocks are sort of saying, we're not too worried about things. Rates were saying up until recently, we are a little bit worried about potential recession coming up, but we're having a little bit of that unwind a little bit as you've been talking about. So definitely, are we forecasting worry? Yes, on the vol side of things, but on the equity side of things seem to be pretty good.
So I actually did a post today before our session for members about the chances of a melt up from here, because as you just pointed out, we took out 5750, which is a solid call wall for many, many weeks. We took out the September, was it 26th high of 5767. So we're in all-time high territory for SPX. At the same time, VIX is, as you just mentioned, still very elevated, 20.84. That's nowhere near where we were 15 handle just a few weeks ago before the Fed came in and did its 50 basis point rate cut. So you also alluded to the bond market, and I watched that very closely. So we have some potential policy intervention, I would say, coming in pretty soon because there is too much volatility in the Treasury market. So there is probably going to be some intervention, who knows, right? But the point is that CPI number has bond market a little freaked, and that likely is the event that calms it down. So that's what I'm, half expecting. Any thoughts on not just equity volatility, which has stayed elevated while the market has moved higher, but also bond volatility, MOVE index in particular?
Yeah, and I mean, it's there for a reason, because I think the narratives are shifting a little bit. We sort of went from being primarily worried about inflation to Powell being worried about unemployment and growth for about 20 minutes. And then maybe this sort of shift back to, well, things are kind of hot. Maybe we're overdoing it on the rate expectation sides of things. So there is that's sort of the bigger moving part from the profit standpoint. S&P profits at all-time highs, stocks generally doing okay. We're going into earnings season, so maybe there's a little bit of uncertainty on that side of things. People aren't really talking about that as much because there's so many other things to focus on. But that could be contributing to some worry as well. But generally speaking, things are looking okay on the equity side of things. Where things are up in the air are fixed income or rates, and that speaks to the MOVE index, which has remained somewhat resilient. But definitely, this is sort of one of the weirdest climb the wall of worry markets that I've seen. It's amazing. No matter how long you've been doing this, and I've done this almost 30 years now on the professional side, and you're always surprised again and again. And I've never quite seen markets, continually pushing all-time highs, sort of steadily day after day, and a VIX being 21, 22, very, very unusual. So yeah, definitely some strange stuff going on there. And interestingly, from a hedger's perspective, because of course with LaDuc clients, I talk about hedging and protecting the downside, and we do collars and we do downside protection because we're always kind of thinking of offense and defense. There's sort of lately you've been making money on stocks and hedges because there's sort of been this persistent bid to volatility, which helps your hedges. So it's kind of this almost like a weird sort of Goldilocks scenario where everybody gets to make money, and that's a little bit unsettling as well. So it almost makes me think that it's almost too good, right? It's like a perfect kind of scenario here.
Oh, well, maybe we've just been doing this a while. So we're spotting all these different pockets that typically represent, outliers that revert. They're not. The strength continues to bid up an equities market into an election. That's not a surprise. But let's talk about this volatility chart that you put up for clients. Can you talk to this? This was actually last week as well. So I think this might be a week. It's October 1st, but explain this a little bit.
Yeah, so this is showing the tendency for, how reactive is the VIX to a move down in the S&P or to a move up for that matter. But we're a little bit more concerned about the move down in the S&P lately. And so we've seen that any kind of moves are accompanied by very, very quick reactions from the VIX. So very high beta, which is not, when we say something is in the 98th or 99th percentile, we're talking about the very, very high end of the range of observations. So, definitely there's this, we call that the beta of a product. So the beta of the VIX to a change in the S&P is very, very high, which means it's almost like I like to use that sort of cat in the room full of rocking chairs scenario. The cat is very, very nervous. And the more rocking chairs you kind of bring into the room, the more nervous it gets. And so as we keep adding these things, election and then the dock workers and these other things we've been talking about, it just seems to get more and more nervous. What we need is some sort of calming effect. And as long as, for example, if you pick the election, as long as Trump and Harris are relatively close, that's going to represent uncertainty, and markets don't like uncertainty, and certainly the volatility markets don't like uncertainty. So if we start to see kind of a little bit more of a breakaway from one party or the other, then we might see markets kind of relax a little bit because it's not so much one or the other that sometimes makes markets nervous. It's the not knowing that is difficult for markets to kind of handle. So we'll see if that changes. That's something that could kind of bring down that level. And then, of course, as we sort of move past the election, the VIX is going to sort of look past that, and then maybe we see a little bit of a relaxation that kind of will bring things more in line with what we're seeing in equity markets, which is things being quite strong, quite firm.
Let's talk about this chart that we also discussed yesterday, a little bit of the 3-month ratio with spot VIX and how it is showing a very large divergence, this yellow band that I tried to highlight. This is just most recent. You can kind of tell when it gets extremely oversold, like VIX was at 65. Clearly, it has a reflexive bounce back inside the band and the market moves higher. Once it gets to the top of this zone, it typically means price is going to go sideways for a little bit. But big picture, we've been kind of spying this. You are tracking the VIX backwardation, which is not often, right? It's mostly in contango. And for right now, this is an opportunity if it bounces higher for markets to move with it, Or if this breaks that one level that I'm showing here, it actually is risk off. So we could have a quick, sharp pullback in markets. Place your bets.
Right.
What you
What I
got?
mean, right now, the VIX picture. So when we sort of look at the VIX futures and we look at where the VIX cash is, because there's slightly different things, and then there's S&P at the money, volatility, and so you've got all these sort of moving parts when you're in this neck of the country when you're trading volatility. And so the picture is not one of health right now. So it's one of quite a bit of nervousness, quite a bit of caution. So, and sometimes that can be, it can be a sign that maybe we're getting stretched to a point where it is time, just like 60, 50 or 60 VIX was probably a decent sign that you could dip your toe back into markets. We might be getting to a point where if we can sort of put aside some of these worries, markets may have that chance. And you and I have been talking about 6,000. The path might be a little bit uncertain as to how we get to 6,000. But if we can kind of alleviate some of these concerns, that VIX 22, 23 can actually be a sign of, maybe maybe the path could be one that heads towards a little bit calmer waters. And that'll give the market a chance to maybe have that real melt up, which it seems to want to do, but it keeps running into these sort of shorter term issues.
Yeah, it's running into shorter term issues because we still have massive impact from Milton expected. That's just incredibly destructive. Lives, pets, homes, livelihoods, but also to GDP and employment. So the bond market is definitely positioning since the Fed rate cut with higher yields and, by the way, dollar, but they were also very large shorts. So the positioning was short the dollar, short the yields, and now they are unwinding. I'm just showing you the T-note futures with the 10-year and 2-year side by side right before the inflation data comes in tomorrow, which is expected to be, year over year 2.3, right? And so it's not really going to show an increase, I don't believe, especially right before the election. So we should, quote unquote, get some support in the bond market. That's my baseline bet anyway for this pull down that we've timed with bonds falling with bond proxies. It's worked really great. As a result, equities also, this kind of risk parity has worked with higher markets, and growth has played out pretty well. Semis have taken a leg recently, especially after the China digestion. But for the most part, your comment about this volatility not pricing in lots of risk and the bond market accordingly. What if we do get this sweet spot tomorrow where they're saying, hey, Fed really doesn't have to cut aggressively into end of year. They kind of pull out some of those rate cuts. We could have some gyration in volatility. We could have some very quick pullback in the markets. Otherwise, we're climbing that wall of worry. When does VIX start losing its power? In other words, these positions start kind of giving up on higher, and it dumps. What's your look right now for expiration, especially in VIX?
Yeah, well, I mean, the VIX AUK future is kind of glued to the cash right now. So it's sort of, it really looks like we're probably going to stay fairly steady for the next little while in terms of volatility not moving down. And certainly the evidence of that is in markets where we can see the VIX really hanging in there. Even today, we had a really nice move up in the S&P. And it's not in everything, right? You can see sort of, some areas are doing well, some aren't. Be interested to see, but we've seen TLT really, really pull back. We've seen some of the bond proxies really pull back. And the question is, when do we start to kind of move back into some of these almost, some of the more maybe defensive type areas? If indeed we kind of feel like the giant rate cuts aren't coming, right? The giant rate cuts aren't coming. And there's a distinct possibility of that. We've had a lot of Fed speakers kind of throwing around different opinions, and some contrary to
18
what's held.
scheduled this week and
Yeah,
16 last week.
it's ridiculous. It's actually ridiculous. I don't know why they need to massage every moment of every day. They need to be massaging markets. It's quite
Yeah.
incredible. It's really unnecessary, but in itself, that sort of almost creates less volatility, right? Because there's sort of this sort of, constant chitter chatter
Ooh.
about what's going on, and you're not sort of waiting from event to event to find out some sort of data that you may not know. They're sort of massaging everything, micromanaging the messaging, and that can also sort of take out volatility as well.
And cause credit spreads to fall, which has been very bullish for equities. One that I actually have shared with clients, and it's impressive, is the high yield adjusted is at a level right now. This 2.89 is at a 2007 low.
Wow.
So, and this could absolutely reverse higher, but it typically takes a few months. It's not going to just be one and done. So this will be that'll definitely bear watching. Let's just put it that way. But that's also one of the reasons why equity holders have been rewarded. Credit markets aren't seeing risk.
Yeah.
Volatility is elevated. They're buying hedges, but the credit
Right.
market doesn't see the risk.
Isn't that interesting? And they really are buying hedges. And we're going to look at that in a moment, a couple of
Please.
examples
Yep.
of that, where you kind of see that. And I like to call this kind of the sort of effect that, when everybody's looking to the left, sometimes you kind of take a peek to the right to look for the opportunity. So when everybody's sort of worried about the downside, the upside can get priced a little bit lower. They're really putting all their sort of efforts into pushing up these protective hedges, and that's making the upside look kind of interesting. So upside call spreads, upside calls in certain things are really looking quite cheap. So if you are of the opinion that markets can continue to climb this wall of worry, and as soon as these sort of layers of concern start to peel away, and that kind of creates this coast is clear sort of idea, then maybe that upside will get repriced. So you'll make money if you buy sort of out of the money structures just by upside being repriced. And we've seen that at times. We saw that in the Russell when it started to break out there. Upside was priced very, very aggressively. So at some point, the market may realize that they focused a little bit too much on the downside and they've forgotten about what we call the right tail. The left tail is generally where people focus. The right tail can get underpriced.
Show us the left tail. Show us how you can spot the hedges that have come in of size. I am, yes, take it away.
Okay, so here we
Love
are. We
this.
got this weird market. There's our old friend
That's
Oprah again,
awesome.
she's making money on stocks and hedges. She's very, very happy. And so yeah, so we're looking at a couple of interesting things here, which is we haven't covered this. We've got this sort of CTA, which is I think you had a chart you showed the other day
I did two charts, one of the dollar, one of treasuries.
super, super high positioning in markets, which in itself you would think would be, you'd figure it was sort of everyone's full on long at this point, which tends to be kind of a sign of over concentration to the long side. But the fact is that a lot of people are long. The CTA positioning though is starting to get a little bit concerning. Now, if we start to get markets crack a little bit, and this is sort of how this is the world that we're in right now in the volatility space, is that we're very much in a volatility clustering sort of world where volatility can stay very, very high or it can stay very, very low for a long time. And so everybody I always talk about VIX a la mode, which I like everything a la mode. You can put a scoop of ice cream on anything for me and I'm happy. So the reason I'm using la mode is because everyone thinks of the VIX being this mean reverting product that goes to 20, right? It always eventually makes its way back to 20, which is an area of more concern. But the fact is that the mode of the VIX, and I don't want to give anyone PTSD if they start to bring back memories of high school math, but the mode is where you get the largest number of occurrences in a very large sample. And the fact is the mode of the VIX is closer to 12 and a half. And so what this means is that a lot of the time we will get very, very sharp early August type events that pull the average level of VIX up. Those are the crazy events that lead us to believe that the VIX is always going to head back to 20. But the reality is, and very few people talk about this, is that the mode is where the VIX is truly, truly comfortable. And so we sort of live in these two worlds now where either all heck is breaking loose or everything's just perfectly fine. And part of the reason for that is, some of these products like the CTA world, the vol targeting world, the synthetic gamma. So these products, all these ETPs out there that if things get ugly, suddenly they have to start selling into sell-offs. And so this is sort of the reality of it is that if things are calm, it actually creates more calm. But if we start to get the market down to say 5650, 5600, that's where the acceleration of selling can happen. So what that means is, in a nutshell, is down 1 to 2%, the market can handle all week long. Down 5% could mean down 10%. So this is sort of this world that we live in. But really, eventually, we're going to get that VIX back down to this level, and everyone's going to go, boy, does volatility ever go up? It never goes up. I remember periods like that where people complain that volatility never goes up. But when you're in this kind of environment, you feel like it's never going to go down again, and you live in these two worlds.
I love this. This is excellent. Before you go to the next chart, let me just ask a question. So my chart that I showed was same idea, right? CTA, Goldman estimates, and they were basically in a situation where they needed to sell no matter what for October. The first week of October, we had actually stealth QE under the surface that I wrote about, to the tune of 225 billion. So whatever was sold last week was clearly absorbed through TGA and RRP. But this is the chart that I was most kind of interested in getting your thoughts. You just did a great job of explaining, okay, we're hedging because of all of these reasons that make a lot of sense. And I have said, don't be complacent. Don't get rid of your hedges. But this type of thing is the net long, right? In positioning that is way, way outlier. So what do you do when you look at the market that is still squeezing higher? We're in all-time high territory today, and we could melt up even if the first chart that I showed you shows that, VIX suppression and melting down into expiration. SPX is going to get a bid, growth is going to get a bid, etc. But what do you do knowing that we are so extended, big picture in positioning?
And that's really part of the part of this big mishmash of what makes people nervous is that, when everybody's in, there's nobody left.
Crowded.
There's nobody left to get in. And exactly. There's nobody left to add to the party. The party is full. It is at capacity. And so that world that you just showed is a party at capacity. And so I think there is reason to believe that, we could get that 3, 4, 5% sell-off quite easily. And it's going to happen very unexpectedly. So what I always tell clients is, listen, and I used to trade full-time as a market maker, and I loved down markets as much as up markets. I'm a little bit more in the world of, I prefer an up market, certainly for my investments, my personal investments. So I'm a believer in, look, whatever they're doing out there, and we saw money supply, M2 money supply start to break out again. I mean, we are in this world awash in liquidity, awash in cash, and you can call it whatever you want. It is this massive house of cards. But my view is that you bet on the house of cards. You bet on the punch bowl, and you hedge for when the party gets a little bit too rowdy and people start throwing TVs out the window, right? So this is sort of the reality of things, I think, for people, rather than being just sort of a perma bear. And you and I know perma bears and people who haven't made money for 12 years because all they ever want to talk about is how everything's screwed and we're all doomed. And
or got out because in 2016 they were fearful that Trump was going to upend the apple cart. We ended up spiking higher and moving higher, and then Biden came in and we moved higher. They have an invested interest to keep everything going. So,
right.
So we cannot be perma bear or perma bull, although it is statistically absolutely relevant that markets go up a lot more than down. What we're trying to do is time the volatility. So folks can obviously protect capital, also make some alpha, and the sector rotation and the stock selection. So right now, that positioning chart that I showed you was actually September 24th. The CTA chart that you just showed is October 1st, and they are in sell mode for the rest of the month. But until we get a more selling, like you said, that disruption of like a 2% down day, We
Right.
can grind higher until the cows come home. And that's basically what we're doing.
Exactly. And then the amazing thing about some of these products, these vol targeting products, for example, is the quieter things get, the more they allocate to the market. And the more they allocate to the market, the quieter things get. So it's this sort of positive feedback loop that really leads to this. What I'm talking about here is volatility can really cluster, and it can eventually it'll get low again. It'll be very, very difficult to get that volatility up from there. It will be stuck at low levels again. And we're going to need that, as you always talk about, you're going to need a spark. You're going to need that accelerant, that reason
To
for what's
interrupt the flows.
exactly. It's
So that's
very
my
difficult.
whole thing. I guess I'm bullish because I believe that the flows, this dynamic that you're showing, not just with positioning, but also with options, is very bullish. We need a macro trigger to interrupt the flows. That's my.
We do. And so, and you know what, this is all, it's all great because, you know, you and I both love volatility because it creates
Mhm.
opportunity. If you're a long-term investor, you don't want to look at your investments for the next 17 years, then great, don't worry about it. But we're in the business of looking for opportunity. And that's what I do in my Slack room, which I run at LaDuc. You know, all the experts have their own rooms. And so we talk about all kinds of things. I'll show you a couple of neat strategies in a moment, but it
Yes.
really, you know, it's simple. When volatility is high, that creates opportunity. And when people are worried about the downside, well, we can create interesting structures that take advantage of that worry. And I think that's a very exciting thing. Here's the event premia. I thought this was kind of interesting. I don't know if you saw this one, Samantha, but this shows the biggest events of the past year. And we can see the US election being absolutely massive in terms of
Massive.
the premium that people are putting on it. So what I did was I flipped this on its side just so we can kind of read some of these. The US election, NFP, which was last November. We've got a couple recent events here. The CPI from September 11, FOMC from not that long ago. So a lot of recent events have been higher volatility. So this is interesting. You can see that a lot of the volatile, the
Mm.
expectation for volatility has been really clustered into a lot of 2024 events. Look at this. All of these are 2024 events. And over the past year, of course, we're getting towards the end of the year, so that makes sense to some extent. But a lot of worry this year, and it's really culminating in this election. You know, we had, remember when NVIDIA not long ago, that was the biggest earnings event ever. People were like literally in bars. You know, the bar went quiet when the earnings came out after 4 o'clock. It's become one of those things. It's like the Super Bowl or something. You know, they could almost sell tickets to these things. And so, you know, and then we had that FOMC, and then that was the biggest FOMC in years. Remember, we had this
And
incredible
tomorrow is CPI,
anticipation.
and it's the biggest CPI. It's
CPI,
exactly.
it's the biggest, it's the
Exactly.
biggest. And so this is sort of the world we're in, I think, at this point again, which is we're waiting for every single data point. Is there going to be inflation? What's growth look like in the economy? So we're just jumping from data point to data point, and it is a little bit fascinating. At some point, as markets always do, they're going to calm down. So this is one of the ideas I had. I was talking about this idea of, you know, and I have it written up here, when everyone is looking left, take a peek to the right. And so when you look at stocks these days, you find these interesting situations where I like to look at skew. That it informs a lot of my strategy because it sort of it tells me where people are positioned and where there might be value. And so anything above the zero line here is where puts are expensive, and anything below this zero line is where calls are expensive. So this was in anticipation of Nvidia's one of the events. It was before the big split, and so everyone was paying up to the upside, and they were right. We had this big run. So one of the interesting things about the last few years is that retail positioning and options can often be an indicator, and it can create these almost magnets, like the NF the JPM caller the other day. It almost acted as this magnet. The option world has become so big that it is very influential on what equities actually do. And so here you had that sort of very, very expensive call skew. And then here in August, everyone was clamoring for protection. And here again, we have puts quite expensive, and so much so that if you look at it on this other skew chart, you can see that they're really disinterested in upside calls. in the upside structure. So this would be something you'd consider normal, very flat kind of skew, which is the 52-week average for NVIDIA, higher volatility, and very sort of flat upside to flat downside. Right now, you have this steep downside where everyone's paying up for protection, which we're seeing across the board in many, many different products in the S&P and then many other individual names. And they're really not interested in upside here. And that's where we can kind of create an interesting outcome by using options in the right way. Here's another way of looking at that. We call this, sometimes when it looks like this, we call that the volatility smile. Right now, it's kind of a volatility smirk, right? The one side is up and this side's sort of flat. So we have that smirk in there, but we can take advantage of the smirk by doing a finance structure. And you were talking a little bit about something like this as well. You can sell, say, like a 110, 115 put on NVIDIA and use that because when you sell a put, you receive funds. And that's called credit. And you take that credit and you use it to fund some upside. So you buy a call or you buy a call spread, which would be buying a call nearer to where the stock is trading and then selling a call that's further away. And you can finance something for almost net zero cost. You can create upside potential, really literally, in NVIDIA, as long as you say, well, I'm willing to buy it under 110, 115. And what a lot of people will do is they'll determine that put level based on, let's say, somewhere where there's support on the chart. Some people might even determine what strike they want to sell based on valuation. They might say, you know what, down at 110 or 105, I think NVIDIA has a compelling valuation. So there are many ways to kind of decide on what strike you sell, and whichever one it is. When the structure, when the curve looks like this, you have different ways to kind of play this. So I think that's very exciting right now, and you see that in many different products. I mean, what a difference here between the 52-week average of upside skew and where it is right now. And we're seeing that across a number of different terms too. So it's not just November, December. It keeps going across many different expiries.
Do you consider, now I know you're looking at this instrument, so am I. This has been a fabulous trade since September 11th, when the NVIDIA literally turned very sharply higher and the market turned with it. It made up 55% of the advance that particular day. And it was a notable advance because nothing else was really moving. So it made up the bulk of the move and then it followed through. So are you worried at all, though, with earnings coming up, which is November it's after election, but let me just go check real quick. In other words, would you make any adjustments November 19th? So we have the election on the 5th, we have FOMC on the 7th, we have the earnings for NVIDIA on the 19th, and lots of non-farm payrolls and one non-farm payroll, lots of jobless claims. We have stuff going on, plus hurricanes, plus Middle East. But my point is, specifically earnings, is there anything you would adjust in your analysis or in your option tactic, given the biggest movement for the price with earnings coming up on the 19th?
Well, what you could do, and this is something I like to do particularly when the VIX is above 20, instead of selling a put, now you're not going to get as much of a credit, but instead of selling a put, you could sell a put spread. And that's generally the way I like to go when volatility levels are high and uncertainty is high. And as we know, underlying stock movement is probably, 70-75% related to broader market movement, overall. And so, there are ways that we can mitigate some of that downside risk. If you really don't want to own NVIDIA down around that 110, 115 level, and you want to give yourself a little bit of crash protection, you could sell the 120, buy the 115, and give yourself a little bit of protection. And it's fun to have those kinds of, short verticals, because if the market does sell off, what you can do is you can just sell out the put at some point, monetize the put, and then just keep that other short leg, and you end up owning NVIDIA, but you've basically, financed it a little bit with that long put. So, different ways to kind of skin a cat here, but
it also helps with margin if you are using the put spread. But you want to talk about margin impact with something that is, a financed call spread, for example?
Absolutely. Yeah. Yeah, definitely. So margin is a big thing if you have, and especially if you have a smaller account, using spreads are really going to enable you to reduce that margin usage. Definitely. If you have a big account or if you have margin, you can get into sort of interesting things that we often use, 1x2s, back spreads, front spreads, things like that, that tend to cost quite a bit more margin wise. So using spreads really going to help you to reduce that. Another trade I was looking at was Tesla. I was kind of looking at Tesla thinking, this event is kind of interesting. We're going into it. I think it's tomorrow, actually.
10-10.
10-10, that's right. Okay, tomorrow. And so the event vol has been very steep. So everyone's sort of, buying calls, buying puts into this event, thinking that there's going to be a massive move. And sometimes what you can do is you can use a calendar to play that. You can sell the event vol and buy something a little further out. Right now, this chart I think is a day or two old. So the problem is right now everything has gotten so high. The problem with the calendar is you end up owning something a little further out. But if it's too high, you still have that Vega exposure. So if they're definitely going to bring down that event vol, there's no question after the event. But the problem is they might bring down some of these further ones. So this was a trade that was kind of setting up really nicely about a week ago when I talked about it originally. Right now, it's not looking as good. So I wouldn't do it because you can see the whole curve. This sort of dark shaded area is the 90th percentile and the 10th percentile on a product called Spot Gamma. It was a great product to analyze things. And we're sort of trading at that 90th to even 100th percentile. So it doesn't line up that well at this point for a calendar. So I decided to move on from there. But what really did look kind of interesting to me is I had a client come to me and say, you know what, Hans, I've done really well on Tesla. It was down in the dumps for a long time. Remember when it was 175, 180, and all the Tesla fans were upset. Now we're back up to 240, 245. We were as high as I think 265 at one point.
Yep.
So he's got 2,000 shares, and he said, I'm getting a little bit nervous, especially going into this, the election and all the other things that we've been talking a lot about. And he said, is there a way to? But I don't want to miss the upside. So I said, well, look, you've got 2,000 shares. What you can do is you can monetize 1,000 of that, sell out 1,000. And I'm going to show you a way that you can still retain pretty much the same upside up to a certain point by doing something called a front spread. And that's kind of a fancy name for basically buying one call and selling two further out of the money calls. So what we did is I said, look, get rid of one of your 2,000 shares and instead buy the 260 put, which I think was trading around $12.76 to $13. And sell two of the 643 calls. So buy the 260 call, sell two of the 295 calls, which gives you this $35 spread for free because if you get two of these for 643, that's going to more than pay for the amount that you're paying for the 260. So you're buying 10, selling 20, and you're still long that 1,000 shares. Now, what you do have to do is you have to agree to sell all of your shares at 295. But what this does as compared to just being long 1,000 shares, if you're long 1,000 shares and it goes up another $40, you're going to make 40 grand. But if you have this free call spread on, this ratio spread, you're going to grab an extra $35,000 just as though you owned 2,000 shares. So it's a way for you to get rid of half of your stock, but the position up to 295 is actually going to look like you're long the full 2,000 that you had before. But now you have this wonderful ability to take the extra money that you've raised by selling that 1,000 sitting in cash if you're cautious.
All right, Hans clearly had a warning. Battery is low. If he's able to tuck back in, super. Otherwise, the power hour is going to be the power 45 minutes. All right. So for those who are still with us, Hans is not only our contributor in our member Slack workstation here, but he also provides a course on options. He has lots of experience as a market maker and portfolio manager with options, overlay strategies, and the rest. So you can see that we're obviously really excited about options at LaDuc Trading, but he does have a course that we have on our website, LaDucTrading.com/Hans. We also make it available very much so at a discount for members. We invite you to check us out. So whether it is the course of teaching options and mentoring, or also coming in and getting directional plays on market sector and stocks. This is why we're coming together for these Wednesday after market close macro to micro options power hour, so you could see the style of analysis and how we work with clients directly.
And to your point, I heard you talking about the mentoring and the teaching. We're going to talk about interesting things, and we're going to talk about some quieter things, and definitely a lot of what we do is kind of your covered calls, and we do cash secured puts and some of the more kind of mundane but very, very effective things, which are pretty good these days with volatility levels quite high. If you're comfortable with the market here, as we've been talking about, there are some nice ways to monetize that volatility, which is really what you're doing. You're taking sentiment, and right now we know sentiment is elevated, it is nervous, and we can monetize that via the selling of options. So it's kind of a good environment for that. But we're going to talk about fun things, but just so people don't get the wrong idea that we're doing all these kind of bizarre strategies, but they are fun to talk about. I thought this was kind of interesting to look at. So we've got that BABA trade as well. But I thought
we're going to talk about the BABA. Yeah, because they're going to meet this Saturday, and that's going to be chaotic as it relates to positioning. But which one do you want to talk about first?
Well, yeah, the BABA is interesting because we've had this sort of parabolic move, and then a few people in the community were asking me after we had this first bump up, and they said, should I sell my positions? I said, no, I think we should play for more upside because I think things are going to keep going. You were talking about that too, Samantha. So hopefully we kept some people in this trade. But what's happened here with the BABA is you've had this incredible explosion in volatility. And it's interesting because typically when stocks go up, you get a relaxing of volatility, right? When the S&P goes up, the VIX goes down. Under normal circumstances, this was anything but normal. We had parabolic moves. And when you get these parabolic moves, volatility goes, when I say volatility, I mean option pricing. That's what the term I use. For implied vol goes up. So we've had this option pricing explode, which makes a lot of sense when a product goes from 84 to 116. That is a lot of upside volatility, but it's still volatility. We tend to think of volatility as downside, as something negative, but it can be positive, right? Volatility can be positive for BABA holders, that's for sure. And so what I did recently is I put a trade in the community for an iron condor because the volatility got so high, and then we finally had this little pullback in here and then a retest that didn't really get any higher. And that to me was a sign that, okay, this 100th percentile, very, very high volatility is probably going to come back in. And you were talking about how this parabola is about to stop dead in its tracks, and it did. Well, exactly.
I said it's hitting a wall on a monthly time frame. A week, you know me, I zoom out to weekly and monthly, and it was very clearly hitting a wall. And then, of course, the whole expectation of Golden Week ending. China called a meeting to talk about potential fiscal stimulus on the 8th. At the reopening of the Shanghai Stock Exchange, and it disappointed. So the result was the stocks obviously came in, it hit that wall anyway. I expected that. But big picture, it can fall and base and move higher later, but it's the fiscal spending that the market was really anticipating, expecting, hoping for. They disappointed on the 8th. So then they said, take two. We're going to have another meeting on Saturday. So this is going to create more volatility in this structure because some are going to think, all right, they recognize their mistake. They gave us monetary 2 weeks ago, but they still need to give us fiscal. They're going to come back in on Saturday and announce that. Now, to be perfectly frank, Jeffrey says they don't even need it. But the point is the capital market is expecting it. So now how do you structure a trade that could be bullish or more disappointment with that type of backdrop? Because macro is what interrupts the flows.
Right. And so that's the question. And you put up a very interesting chart. You've been showing it for a few days now of this kind of very important level. Do you have that one handy? Is it Shanghai?
It is
Samantha?
Shanghai. I'll get it in 2 seconds. Hold
Yeah,
on.
see if you can find it. And I think that's really, really interesting for people to watch who are interested in this China trade and this potential follow through to the upside. Or perhaps the question of, are we going to get this sort of relaxing a little bit if people, if things come back down to reality a bit. So now I'm playing it with this iron condor because when you get vol this high, you're able to position your wings very, very far apart. So mine are 92.5, 87.5, and then 150, 155 to the upside. And so a lot of people think that structures like this are all about theta decay. And, you put on an iron condor and you wait for those dollars to trickle in day after day. A lot of the time, the big benefit can come from Vega exposure. And all that means is if volatility drops, that's where your torque comes from. And I like to put on iron condors when I think that gets me excited to think that volatility is going to drop. Not that I'm going to make 5 cents every day from here, to the next, for the next 10 days. Volatility is really where the torque comes from in these. So this is a great situation. I would not worry about that structure to the downside because worst case scenario, I'm going to let myself get assigned on BABA at, at $91 basically. To the upside, I would probably start to worry about 125, 130. I would consider taking that off. But for now, I'm just going to sort of wait and see how this looks. And of course, all eyes are on Saturday. And I think you're right. People are just expecting them to really kind of spike the punch bowl again and get people excited. But I want people to see this chart. Let me just give back.
All right.
Control.
I stopped my share. Oh, I thought it is showing.
There you go.
Yeah. So you can see this is the monthly. So that's the one it needs to get and stay above. And their expectation of fiscal spending is what would propel it higher. I have my doubts. So that's why I did the review on October 3rd from the trading room saying China's hitting a wall.
Right. And that was timely. If it gets through there, I think the game gets very, very interesting again, because as we've been talking about, it has been very underloved for years. They haven't done the right things. And everyone thinks, okay, this is a turning point. They're finally going to drink the Kool-Aid and get things moving again. And that has a lot of meaning for many areas, commodities, all kinds of different areas. So I think it has a lot
of meaning for commodities, which is very key here domestically. But the problem isn't just that folks are expecting this rotation with China continuing its monetary easing and fiscal, which it hasn't done now. Remember, still to come. It means they haven't announced any fiscal. The problem is it is still unloved for a reason. U.S. and China relations are not stellar. We still have a lot of risk that large institutions will not touch this play. So there is going to be compliance issues with some. But the hedge funds, like the Teppers of the world, like Jeffrey, our own Jeffrey Fourey at LaDucTrading, he has been long and strong this sector because it's just so incredibly cheap. So we will have this, I think, digestion at that wall, and it will take a few months. It is not going to just be one and done unless you saw the other cycles, right? 2015, where they really did cut rates aggressively. Remember 2015, we had a surprise VIX spike, and the reserve requirement ratio in China was the reason for the season. This is different now. It's not the same market. So I think we're going to have a lot more basing before we can get and stay above that line in the sand. I'm going to end it here because we're having a little bit of technical difficulty, but we'll come back next Wednesday. Please definitely check us out on Wednesday, 4 o'clock. We're doing these option power hour meetings to identify trades that we see, how we analyze the market. And then, of course, if you're interested in getting more in-depth training for options and how to use it to assist getting alpha and or protection of your portfolio with overlay hedges, this is something Hans does extremely well. I can see Jason is commenting, highly recommend Hans's work. Absolutely. So that's why we're really, really happy to be working together and why we're doing these Wednesday macro to micro power hour sessions for options. All right, I'm going to wish everyone a great afternoon. Thank you so much. Bye.
Join Hans Options Education course by scanning this QR code or by clicking on the link in the description. Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.